All right. Welcome, everybody. Let's make sure everybody sits down. It's time to get started. I'll start a little informally. In fact, I'm even going to start with a bit of a market update. It's a day that we can actually update something in this marketplace. So I got that going for me. Yeah, chat in. Let us know that you hear us all right, where you guys are joining us from. Look, we are streaming this live. Everybody always asks that question. Is it live? Oh, it's live. It's not Memorex. It's definitely live. So yeah, chat in. Where are you guys joining us from? Could be anywhere and everywhere. Just want to make sure that you guys hear us all right, see us all right. Okay. Hello. So welcome. I am streaming live from I'm in Payson, Arizona. If you guys have absolutely no idea what a Payson, Arizona is, that's okay. People from Arizona don't even know what Payson is. It's a small mountain town, about an hour and a half outside of Phoenix, but we're just about 5,000 feet here, so it's cooler. It's not that much cooler because it's about 115 degrees in Phoenix right now. It'll probably be like upper 90s today. I could deal with that. Okay, I could deal with it. Cool. Somebody in from Honduras. It's a good place. Okay, a couple of Minnesota, France, all kinds of chaos going there. Nice. We're okay. A couple of people from Tennessee, Toronto. We won't hold that against you. Actually, it was probably one of the best cities in the summer, hands down. Probably in the top three of the best cities I've ever been to in the summer is Toronto. That's because there's nothing going on there 9 months out of the year. So, something has to go right in the summer. Anyway, with that, I'm done insulting all of your cities here. So as I said to you guys, to get started here, so in a few minutes, we're going to start with the crush events. And I'm going to talk in detail to you about crush events. Before that, though, there's actually some interesting market action today, and I think it's probably grabbing a lot of people's attention. So I figured, let's go for it. Let's actually give you guys a quick market update. Right off the bat over here. Oh, cool. Somebody actually drove through Payson on Sunday. I didn't say you were missing it. No, it's like 2 seconds of driving through here. All right. This is second dose of caffeine. Second dose of caffeine. There's going to be a lot of it. So I'm actually going to run quite a distance today. I've got a lot. Like we're calling it like a mini master class here. This is going to be a full blown, like pretty intense hour and a half or so coming up right now. And I want you guys to know that right up front. So as I was saying, a little bit of a market update. It's one of the first days in quite some time that you've seen any sell side activity to the broader marketplace. In fact, let me actually display this by bringing up the spiders. The current pullback in the marketplace, just bear with me on this thought, the current pullback in the marketplace has gotten us back to, well, where we started yesterday. So this is not a broad-based pullback just yet. In fact, I'm going to further that with saying, look, we haven't even moved 1%. One of the areas that I've just been harping on extensively lately is that you tend to lose kind of what we term orientation when it's a very one-sided marketplace. And losing orientation be really, really dangerous. One of the things people are not familiar with now is, look, you're dealing with a $5,635 product. You got to have like a 56-point move just for a 1% move, right? So sometimes pay attention more to percentages. Now, the NASDAQ is moving today. And one of the biggest movers on the screen, one of the most imperative things to watch today is going to be the Russell. So, all right, two things I just mentioned. Number one, watch percentage moves in the S&P. The reason being, a 1% move in S&P not only isn't it statistically significant, okay, it should happen about once every 10 trading sessions. We've barely seen that kind of trade activity. I mean, volatility is really dampened down. So that's one aspect. Obviously, people are looking at NASDAQ. Now, NASDAQ, I'll give you this. That's getting walloped a little bit. It's down 2%. But you don't get to what we term statistically significant moves until 3%. 3% is where the professional trading world will stand up and be like, take note, 3%. Interestingly, ironically enough, though, you actually are seeing that kind of a move here inside of the Russell. So what I just did is I went from a 30-day 1-hour chart. I just jumped to a 1 minute. What you want to look for very, very carefully today. So obviously orientation percentage moves, that's critical. NASDAQ is down, the Russell is exploding. You're seeing what has been a rotation towards tech. Now you're seeing a counter rotation. The counter rotation is into the small caps. It makes sense. Why are small caps rallying? Because the bonds are rallying. What difference does it make? Well, the bonds, it's going to be lower interest rates. Don't, dilute yourself to that. It's going to be lower interest. Nobody gives a damn about the interest rates. The reason that the small caps are rallying, is the regional banks. Okay, what do the regional banks have to do with this? A rally in the bond market, is easing the massive losses. Regional banks are sitting on hundreds of billions of dollars of losses in this bond market. The bond market fully crashed on them. And we went into a small banking crisis, like less than about 16 months ago. There was actually a banking crisis going on. So the bid back to the bond market is actually alleviating a little bit inside of the Russell. So the Russell, big gasp of air. And meanwhile, now we're rotating out of tech. Specifically, Microsoft's kind of getting hammered a little bit. Tesla, coming off a bit, or more than a bit. Things are getting a little bit more interesting in there. Clearly, Meta down about 3%. Ironically, Costco's down about 3%. It's been a big rotation into Costco, huge positive news on Costco, and actually reacting negatively. Time out. The whole reason I'm covering this right now is not where we are now. Don't let me tell you where we currently are. You can see that on your screen. It's not where we are now. It's where we're going. And the most important thing, between now and the end of today's trading session is right here in this advanced decline line. The advanced decline line, how ironic, is positive. The advanced decline line is positive. So what you've got is a counter rotation. We're buying stuff that no one has wanted to buy in weeks and months. Need I go any further than say Starbucks? No one has touched this company. It is like the bubonic plague. People are now all of a sudden, they're like, I got to get me some of that Starbucks. I heard that's good stuff. Clearly I've had too much of that. I would bring up stocks like Deere. Why? Deere hasn't had an up day like ever. We're rotating into junk that has been sold. You want to see real junk? Bring up like Lululemon. Nobody's bought this thing like ever. Even that, ironically, is up $1 today. I'm serious about this. We're buying junk. Look at McDonald's. So make sure you guys actually see the symbol. Look at McDonald's today. Oh, this thing is it's doing its own thing over here. Look at McDonald's today. No one's touched McDonald's all year long. Huge bid under it. So what matters later today? Later today, what matters? Can the NASDAQ and the sell side activity in the NASDAQ snap the advanced decline line and actually draw us closer to correlation? You will know that this sell-off could be serious if we snap to correlation. As of right now, it's rotation, it's counter rotation, right? This counter rotation into buying junk and selling tech, this could last. This could do some, pretty magnificent damage to markets. There's no question that this could do, magnificent damage to markets. But unquestionably, if you want to know if this is going to be the big one, you're going to see the advanced decline line correlate, because until the advanced decline line, you really want to know why. There's no punch to the selling right now. There's some volume out there, but there's no big punch to the selling. There's no big punch to the selling. As long as that advanced decline line is positive, volatility is not going to move. And if volatility doesn't move, markets are not going to get rocked, period. Why? Because volatility is the key. If volatility starts to move, and you can look at VIX, I look at vol futures. You can look at this thing would go parabolic. And that would basically mean that the trading firms will have to sell everything indiscriminately to mitigate their volatility exposure. So as long as the advanced decline line stays fractured, a higher advanced decline line, I know this blows people away, but a better advanced decline line can actually bring more selling to tech. But a better advanced decline line, will calm fears and volatility. If this advanced decline line is to snap late in today's trading session, then it's on. Then you're going to know some real selling is going to come in. And I wanted to spend the first, 5-10 minutes of this session just giving you guys kind of a quick market update on here. But it's it's kind of fun to see like the rotation and kind of counter rotation in play, because it's been just relentless, right? Like look at this though, the volatility. The volatility right now just goes whatever. It's a rotation. Seen this before. That's it. And that's exactly what it's prefacing. If you take a look at the Russell, long as that Russell continues higher, which it is doing again, and it is vicious out there inside of the Russell, long as the Russell continues higher, you're all good. You're all good. I'm okay to go. Okay to go. Interesting stuff, right? So you will see sectors again that no one has wanted to touch, okay, that everybody's jumping into. Look at this, okay? Most people don't even know like what the XLB is, right? Material sector, okay? All of a sudden, like, healthcare sector is almost breaking out to the upside, okay? Stuff in retail, buy, okay? Like anybody cares about this. Look at this. This one is the regional banks, the KRE. That's the regional banks. That a big enough move for you? I told you that's the move that's on the forefront. Nike, okay? No one has wanted to buy Nike in, well, ever, okay? After that last earnings, period, that one's even positive. Again, Lowe's, okay? Lowe's, no one's touched. Year-to-date basis is basically flat. It's very, very interesting. So we are on the cusp, okay, of what could amount to some bigger volatility. But as I said, the punch of trade it's just not there right now. Okay, you can talk to, you're blue in the face about volume. No one cares. That's more volume right now than we did all day yesterday. No one cares, right? Cool stuff. But I love to explain a little bit about what's going on in real time because, hey, something is going on today. And all we're doing is just countering some of the rotation. Ironically, the Dow, which has also done nothing on a year-to-date basis, the Dow is even up today. So this is sell what has worked and buy what has not day. I like it. You guys ready to get into it? I'll wait for a second. Okay. There's a calm in the crowd. I like it. The fact of the matter is today, we're going to talk about crush events, your guide to earnings related volatility crush. My name again is Don Kaufman. Give you a little formal introduction as we kind of get into this. Risk disclosure. We're not financial advisors nor a broker dealer. Okay. I always bring that up because I spent 15 years in the brokerage world. I'm intimately familiar with the brokerage world. I like this. No soliciting, no recording, no photography. Yeah, we record everything. Okay. I wish, we should just put in here, don't feed the monkeys. Don't feed the monkeys. A few housekeeping items. Look, I'm going to go through a huge amount today. Focus. I'm dead serious about this. Okay. This is a deeper class than I try to pack into like 90 minutes typically. I have a lot of slides, but I'm also going to go live in the trading application. Obviously, I am a extraordinarily well caffeinated individual today. Look, phones on silent mode, close Facebook day. You know what? Just delete Facebook forever. Okay, I'm helping you. Even TikTok. Okay, I need to put TikTok in here. Sorry, I'm not under the age of 35 anymore, so we're not supposed to know what TikTok is. Phones on silent mode. Kick out the kids. You took the time to be here. This is important. So here's a bit about me. Again, there are some people that are attending today because we're streaming this in multiple venues. Some people attending today who maybe have no idea what a Don Kaufman happens to be. I love speaking of myself in the third person. But here's the nickel tour. I say I watched order flow for 15 years. That's in large part why I'm here. So my background, people always have these like long stories of how they got involved in trading. I was a taxi cab driver, and then I was a trader, and then I was a teacher, and then I was a trader, and I was this, and then I was a trader. I grew up around it. Okay. I was a trader, and then I was a trader. Actually, though, I didn't go to college or anything for like, economics. We have a professor of finance, Jeff Bierman, that works here. He's also a professor of finance at Loyola in Chicago. That's not my background. I grew up around traders. I had family that made markets, Chicago Board Options Exchange. in Chicago. They built a trading firm. It was called O'Connor and Associates. That's not the family name. That was actually the two brothers that financed my uncle to build this company. That was back in the 1970s. So when I say I grew up around it, I've been going to Chicago since, before I even remember. I've been down on the trading floors since, I'm like 6, 7 years old. And, right out of college, I got involved in it. That's actually in the late 90s. So I got involved into it. The long story short, I met a couple of traders that were in the OEX pit. They just approached me literally out of the blue. One of those traders was Tom Sosnoff, and his partner was Scott Sheridan. They were market makers at the SIBO. I knew them by sight because Tom at the time was the long hair hippie. So I'd be like, trading with the long hair hippie guy over there. And Tom said, "You're young. You have no idea what you're doing, for the rest of your life." He goes, "We're building a firm. It's called Think or Swim." I'm like, "Think or what?" He's like, "Just forget it, kid. Just come with us." He's like, "We're going to start a startup firm." And I was like, "No, okay." Sounded reasonable to me at the time. So I joined them. I started actually contracting with them all the way back in 2000. I joined them full time in 2001, and I spent basically 15 years there. I was on the executive team. We took the company public in 2007. I was there when TD Ameritrade bought us in 2009, and I had actually signed a 5-year lockup clause with TD Ameritrade. So I built education for both Thinkorswim and TD Ameritrade. The Thinkorswim trading application had a tremendous amount to do with the analytics on there. Myself and a gentleman by the name of Tom Preston worked extensively on analytics over there. So that's a little bit about my background. When I talk about watching order flow is basically I got to see everything you did. And a huge amount of the learning curve that I got in this business, it wasn't from like a market making background. My learning curve was from watching your trades. I had access to the largest options order flow, okay, in the entire, business of the retail business for the better part of 15 years. No one had a larger options order flow than Thinkorswim and TD Ameritrade. I mean, when we were TD Ameritrade, okay, the nearest firm, we were 4x bigger than them, okay, in terms of option order flow. And so what you're going to learn here comes from watching literally billions and others' mistakes and the knowledge of what works best for specifically for retail traders. You ever get a hold of me after today, support theotrade.com. That would be me, but you see me. So this is actually TD Ameritrade TV, IBD. Let's get down to business. This is why you are here today. So by the end of the webcast, I like to put some bullets in here because I want you to be able to walk away, okay, with something very, very definitive. You're going to discover a little bit about volatility crush. Okay. Some people think they kind of know what vol crush is. I'm going to take you to different levels today. So for those of you that have no idea what a volatility crush is, don't you worry, because we're going to be talking about crush events, right? You're going to learn a bit about expected move. This is going to be one of the most comprehensive, okay, reviews of expected move that I have done in the past. I'd have to go back 7 or 8 years to see the most comprehensive review of expected move. Expected move to me, it's everything. It's what I trade on. I'm a quant. Okay. And more importantly, how to use it around earnings. You're going to learn how efficiency in the markets can benefit retail traders. Okay. And you got to harness what's going to benefit you, right? How can you use that? How can it be advantageous for resource in all aspects of your investments, retirement accounts, cash accounts, futures trading? You're going to learn weekly strategies, okay, that can take really minimal risk and produce astonishing returns, okay, around what I've termed predictable or manipulated movements. And again, you're going to discover a very unique method surrounding earnings announcements. You're going to get that and a lot more. And again, we're going to pack this all into the next approximately 90 minutes. You guys good? Okay. Oh, hold on, because this one's going to hurt a little bit. This is going to be a very, very full, okay, event. So let's start with talking about price movement. When you're looking at markets, and we're going to deviate and look at markets a lot. You're looking at markets like, oh yeah, the S&Ps are down 50. Oh yeah. Okay. All right. First of all, it's not even a 1% move, but stocks move. Traders and investors alike can measure those movements after the fact. I mean, it's what's termed historical volatility. Now, I love to give definitions like this, so I put it in there. The annualized standard deviation of past stock price movement. What is historical volatility? I'm going to tell you exactly what it is. Okay. I'm going to tell you exactly what this is. You're driving, okay, 100 miles an hour looking through the rear view mirror. Okay. And that's exactly what it is. Historical volatility tells you the rate at which a product's actually moving. So when we talk about historic vol, we're talking about price action, right? And movement. But it's telling you in hindsight. And the reason I bring this up is, and by the way, we're going to use JP Morgan quite a bit. By the way, this is a screenshot. So screenshot, I think I took it like 2 days ago. That's JP Morgan. And I just want you to see earnings are coming. Okay. But this is historical volatility. So when you're looking at a chart, okay, when you're looking at a chart, and I'm not trying to be facetious here in any way, shape, or form, what do you really see in a chart? Okay. You see everything, okay, behind you. You see everything in hindsight. You know, I think one of the coolest experiences I ever had in my entire trading career, and I love to give a little background on this because I think it just gives incredible insight. But I was there when we built Thinkorswim charts. My group, okay, kind of owned Thinkorswim charts. When I say my group, the trader group that I worked in and was managing trader group, charts belonged to us. This was our territory. And when we first started building charts, all you saw was raw data. So imagine, like, if you guys, how many people here have ever seen the movie The Matrix? If you haven't seen The Matrix, what planet do you live on? Anyway, if you've seen the movie The Matrix, okay, they are looking at a screen and there's just zeros and ones, right? It's like all binary. And all of a sudden, you take all of that binary code and you able to paint it, and it looks like a perfect world. Okay. When you're building a charting package, all you get to see is basically the code. All you get to see is a raw data feed. And it's amazing because all that you really get in the data feed is price and volume. Okay. And every study, and there's like almost 500 studies on the Thinkorswim platform, and you guys can go to TradingView, and there's tens of thousands of studies on TradingView that people have written and so forth. But it's just amazing. Okay. It's amazing in there. And all of it is like, behind you. So JP Morgan, prior to earnings and historical volatility, has subsided, leaving a trader investor blind as to the imminent risk of an earnings announcement. So I wanted to start with this because the chart, okay, what is in this chart that is going to tell us about this earnings announcement? You go, I don't know, is the right answer. Okay, that's what we're here, suffice to say, to figure out, is not, okay, where we've been, okay, but effectively where we're going. And it's such an important concept today. So a market of foresight, looking back, is great. It provides plenty of insight, okay? If we could only produce foresight in the markets and enter the options markets, okay? Most traders, they still view this options marketplace, okay, as an ability to take a shot. When people think about looking, okay, at when people think of like looking at options, they always think of like, let's trade, baby. Like they don't get it yet. Options are a wonderful tool to be able to mitigate risk. They're a wonderful tool to be able to take positions. But use an option market, okay, the way that professionals have used it since they first came out. Use an option market, okay, in respect to what's it saying? Okay, what is the option market saying? And we're going to talk about this for like the next 10 to 15 minutes because it's so incredibly important. Option markets today are truly a cart leading the horse. Okay, and I'm going to deviate back to a trading application again, and I'm going to bring up stuff like NVIDIA. Guys, NVIDIA, or even let's just cut to the chase. Let's go to Tesla. Okay, Tesla has traded 128 million shares today. Holy crap. You have any idea what kind of notional value? Notional value is like how much money? Well, it's $246 stock times 128 million. But you want to see what really is going to blow you away? It's already done 3 million option contracts. Remember, option contracts, one option contract, okay, what's the multiplier? Is 100. So all of a sudden you go, Oh, that's huge, man. Okay. So it's 3 million option contracts. Put a couple of extra zeros on there because this is the cart leading the horse. When I say the cart leading the horse, options market is the driving force behind Tesla. How do I know this? There's put buyers out there today, and there's call sellers, and that's going to drive those shares lower. Okay. It's wild. All right. This is unbridled enthusiasm in a marketplace right now to the downside. So you've seen a 4% move in Nvidia. We've all seen 4% moves in Nvidia, and we've seen to the downside, but this is being led by the options market. Okay. What I'm going to do is I'm going to give you somewhat of a refresher for some of you, but some of you, this is just, bleeding edge stuff. I'm going to give you a view, okay, of the future, a glimpse of the future, because options have the ability, okay, to see that future. And that's what's important. It's a market of foresight. Options are your future. So I'm going to start with a really, really simple question. Okay. And by the way, this is where we're going to actually take, a little Q&A, a little back and forth inside of the different chat rooms we're in here. But why is an option trading for $3? Forget about whatever you think. Well, it depends on the time to expiration. Why is an option trading for $3? Right? And you really got to start thinking about it. You know, um, unbridled enthusiasm. That's exactly where I was going with that one. It's a Seinfeld quote. Okay, I don't get out very often, so it's good. So the thing that people don't get about an option, okay, is, sometimes I'd say, why is it trading for $3? And people go, well, the Black Scholes model, all right. I've met, Myron Scholes a number of times. Okay. I met a lot of people that were involved in the origin of option pricing. And I've had long, discussions with them about what option pricing is. But in the end, okay, it's an implication to future risk. In the end, when you really want to know what an option is about, okay, it is an implication to future risk, nothing more, okay, nothing less. When I say, oh, there's an option trading for $3, we don't need to look at an option chain. We don't need to look at, what's the number of days to expiration? Okay, so time to expiration definitely involves, oh, what's the stock price? Yeah, the stock price definitely influences it. But why is that option really trading for $3? Because that's what somebody's willing to pay for it. The thing that's often missed in an options price that I will just hammer home to you, okay? It is, in the end, a supply and demand instrument. If everybody demands options, prices go up. If everybody actually, okay, offers options for sale, price goes down. It's a supply and demand instrument. And we start talking about this, before we get, oh, let's talk about vol crushes and let's talk about this, okay? In the end, you need to understand that volatility is supply and demand. So volatility, as it is applicable to options markets, volatility is supply and demand. Implied volatility, okay, is supply and demand. And that is such a critical aspect in here. So if we know what to look for in the options marketplace, okay, what we can do is we can convert that. We can take it, we can determine how far stock can move. So if the option market, okay, tells us something that's so useful, why are we not looking at that every single day? We are. That's what expected move is. I always ask people, why are you not using this? We'll use MACDs and Fibonacci's and Bollinger Bands. I got your 618 right here, buddy. But in the end, if you want to know what's expected, look what the option marketplace is saying. So let's get in the know. You may not know, okay, where markets are going, but you can measure how far the markets can move within a given period. Okay, the normal fluctuation is what is termed expected move. So again, some of you are intimately familiar with expected move. As I said to you though earlier, I want to take that, okay, to a new level. That's part of the goal, okay, for this, is to look at this, okay, and say like, oh wow, man, that just gave me like a newfounded understanding of like what the expected move is. So we're going to teach you guys a little bit about expected move. So, like, oh man, I thought you were just going to show me a trade, show me crush events. Unequivocally, we are. But, again, I was using that cart before the horse. Well, we got to kind of show you that the cart, which is the options market, is leading the horse, which is the stock. And that is what is so imperative to understand. If you want to be able to use, okay, the idea of a crush, okay, what is crush? It's when earnings come out. Earnings, everybody's like, oh, they're all about volatility and it's earnings and, oh, the stocks are going to make big moves. The expected move is incredible at being able to handicap, okay, what we're going to do around earnings. And we're going to talk extensively about that because once you understand expected move, the strategy to employ around that, okay, is easier. I mean, that way it's wind at your back and it's just much easier that way when you understand that. Okay. So let's get into it a little bit. What to expect with expected moves. I like saying that. That's kind of fun. All right. Expected move. It does not tell us which way the markets are going. Okay. So time out. Earlier, I was talking about the MACD and the Fibonacci and the Bollinger Band. Those are often used, okay, as predictive forward looks, especially like Fibonacci's like, oh, it's going to retest into my 618. By the way, if there's one thing I really enjoy poking fun at, it's Fibonacci's. Did the magical 618 make me say that? It did. It definitely did. But I'm not into the Fibonacci's. I'm not. Okay. I got your 618 right here, buddy. Nevertheless, and by the way, we have people here at Theo Trade, including Jeff Bierman, definitely Brandon Chapman, Gianna De Poche, that are deeply into Fibonacci's. It's one of the reasons I make it my job to, poke a little bit of fun at those. But I got to tell you, the hottest trader probably here right now is Gianni too. In terms of calling directional moves, he is on fire. This is going to be different. This is not about where you think we're going higher or lower. That can be an assessment. This is going to be about how far are we going to move. And with uncanny access to that, okay, it is critically important that we understand this. And I'm going to use some great examples. So danger, there are expectations. So volatility, movement, and earnings. Very often, okay, where we're going to deviate to an options chain right now. And it doesn't have to be NVIDIA. By the way, when everybody looks, okay, at a trading platform, the first thing they come over here, they go, oh, it's moving this way, it's moving that way. As I said, okay, I'm sorry, I am a member of the matrix over here. I prefer to look at this trade tab, okay, and I know that I'm in the minority. I know every statistic behind the Thinkorswim trading application. Like for example, there's 7 times more impressions on charts than there is in the trade tab, meaning that people actually they will pull charts more than the actual trade tab. I'm like, what are you here to do? They're like, trade. I go, so why are you over in the charts? They're like, because I have to know what to trade. And I'm like, oh, right. Okay. I always start when I look at given products here. Okay. I start here on the trade tab. And it's important. Okay. It's really important. So, I see Gianni commenting. We have multiple, rooms going right now. I see Gianni commenting in one room. Gianni, you're not defending yourself in the other room. And there's a lot more people in that one, buddy. Okay, a lot more people in that one. Gianni's like, what? Anyway, I start here in the trade tab when I look at stuff. And I'm actually going to start with something a little bit more mellow. As I said, I'm going to use JP Morgan a bit today. And the reason I'm using JP Morgan is because it has earnings tomorrow morning. And what we often look at in JP Morgan, like, before earnings, you go, oh, look over here, right there. Okay, what is that? Well, that is, all right, 66.5%. And that's the volatility. And I just freeze right there. I'm so excited about that. I've been doing this forever. I know what 66.5 means. Okay. You probably don't. I mean, some people kind of get it, but some people don't. The first thing you need to know about 66.5, because people love to quote volatility numbers, right? just blank that out for 1 second. As I said, it's going to be one of the most comprehensive discussions I've ever done, okay, in recent times about expected move. So you're looking at this stock, okay, and the stock is JPM, okay. Now, most of the times when I use a stock, I go stock, okay, but in this case, we're actually going to call it a real stock. It's JP Morgan, and JP Morgan currently has a 66% vol before earnings. So what this distribution curve is, if you've never seen like a distribution curve before, okay, everything you do kind of fits under a distribution curve, right? There's like, there's really, really good drivers, really, really bad drivers, and then there's Los Angeles, which is somewhere down here, right? Okay. By the way, though, sometimes I'm in Phoenix, and that's definitely down here too. Could be crazier. I live in the Virgin Islands most of the year. Okay, I don't know where that falls into the curve. Okay, that's fat tails, I tell you. But almost everything you do can fit into a distribution curve. Well, I prefer to look at price action as a distribution. Like I can see that JP Morgan right now, okay, I can see that it's trading at 207. So let's put that in here, okay? So JP Morgan is trading at 207, okay? Sounds reasonable to me. Let me ask you something. Where can JP Morgan go? Well, its earnings are coming out tomorrow. So my guess is it can go where? It can go higher or it can go lower. You're like, newsflash, it can go higher and go lower. So obviously, so all you're looking at in this distribution curve is I gave equal chances. Like, let's get crazy. Let's say it can go up, okay? I don't know, $3. So it can get to 210, okay? Or it can go down $3, get to 204. It can go up even another $3, which would get all the way to like 213 and go down another $3, okay, to 201. All I'm basically doing is showing you it's equivalent. You really want to know what this vol is, okay? The vol, which is volatility, is all puffed up, okay? Why? Because the volatility is trying to wrap its arms around how much JP Morgan is going to move. In the end, volatility, and this volatility that we're looking at, to be quite clear, this is what we term implied volatility. And this implied volatility, okay, it's handicapping, okay, future stock price movement. This implied volatility is handicapping future price movement. Clear the deck completely, okay? Go back to the trading application. Another way to look at implied volatility would be what's termed expected move. And I think that the vast amount of people that are here today, okay, understand what this number is. Okay, when I say this number, all right, $6, okay, and basically 18 cents. So that's a dollar for dollar movement, plus or minus. What that basically means is that JP Morgan is slated to move up $6 or down $6. Okay, when? All right, supposed to move that between today and tomorrow. Now, time out for a second. Time just became a critical factor here. So not only is expected move, okay, related to implied volatility is expected move. Expected move is implied volatility. They're one and the same. But the point of the 66% is such a strange number because, and I'm going to go forward and then I'm going to go back again. Expected move defines a one standard deviation move 68.3% of the time. The way, if you were alive, okay, before like the 1980s, okay, this was like, they used to say it was 67% of the time. And then somebody developed this wonderful thing called a computer and it became 68.3. Okay. Everything, as if you were an engineer in like the 1980s, everything you ever knew was like your whole world was shattered. I thought it was 67%. Okay. This is one of the reasons I pick on engineers. Okay. No, it's actually 68.3%. Okay. It's real and it's spectacular. That 1.3% difference ruined some people. What's 1.3% amongst friends? So when you're looking at that curve, what you're really looking at is a 68% chance of falling in a given range. Now, we're going to go a lot deeper than this. Okay, we're just, scraping the surface, just scraping the surface. The weird thing is this, okay, when we say, okay, volatility, we say volatility equals 66%. The 66% is annualized. Here is the single coolest thing that you can learn about implied volatility. It's universal. No one looks at it that way. It's universal. You can compare immediately once you really understand volatility. Like, I know that we're going to be talking about crush events, and I know we're talking about earnings announcements, but before any of that, okay, are you aware that volatility is universal? When you look at Tesla shares, and Tesla shares are moving big today, or NVIDIA shares, and they're moving big today, they have vastly different market caps. Tesla, an $800 billion company, NVIDIA is a $3 trillion company. Like, how do you even compare the two? There's an easy way to give just a clean comparison, okay? And one of the ways to get a clean comparison between those two is to look. Who cares where the market is right now? It doesn't make a difference. Tesla's down 5%. Do you know, okay, between now and a week from now, that Tesla has a 66% implied volatility? Ironic, right? Because Tesla, all of a sudden, we can compare it to JP Morgan. You go, how's that possible? Tesla's so much more volatile. Not tomorrow. JP Morgan has a 66 vol for tomorrow. Tesla has a 66 vol in the next 8 days. It's kind of a cool comparison. NVIDIA. What's NVIDIA looking like? Well, today is about a 61 vol. So here's the craziest thing to think about. JP Morgan is going through earnings. You're like, oh, earnings are volatile. Not as volatile is pretty much JP Morgan in its earnings announcement is about the same volatility, okay, as Tesla is between now and next week. How crazy is that? All right. And then you go, what about them there, Microsoft? Okay, let's look at Microsoft. It has a 30 vol. 30 vol. Okay. And you go, I don't really know what that means. Even if you don't understand in context like a 30 vol means, okay, you can immediately assess there's a 30 vol, which is Microsoft, versus a 60 vol, okay, which is NVIDIA. NVIDIA is rocking at twice the rate of Microsoft. NVIDIA is a $3 trillion stock. Microsoft could be a $3.5 trillion stock, but Microsoft doesn't mean squat compared to NVIDIA because NVIDIA is rocking at twice the rate. That's what the option market can tell you, that nothing else. You can look at the chart all you want and go, oh, it's very interesting. It's a very, very interesting MACD and a Fibonacci and a Bollinger Band, but it's not telling you at what rate we're moving. Like, oh, I can look at historical volatility. Driving 100 miles an hour, looking in the rearview mirror is a dangerous proposition. But implied volatility, okay, tells you what the future is. Okay, the future is grim. Take a look at Tesla. Okay, take a look at Tesla. You want to really learn something in here? Look at this. This thing's up to like a 94 vol for the remainder of this week. Why? Because it's puking its proverbial guts out, and it's telling you, I'm almost 100 vol. Danger, Will Robinson. I'm almost 100 vol. Okay, and then you go a little further out in time, and all of a sudden, holy crap, what's going on here? It goes from 68 vol to an 85 vol. What's going on here? I'm leading you into something. I'm reading the tea leaves, people. Not tea leaves, it's volatility. You're learning to read vol skew. Learning to read vol skew is instrumental because as you look at this and it jumps from a 68 vol to an 85 vol, earnings, it's a huge warning. It's a huge warning. That is such a cool thing. I actually am going to deviate and go to Tasty. You know why I'm going to go to Tasty? Because Tasty just simply does a much, much better job of denoting where risk is. Okay. See, in Tasty Trade got smart and they actually put an E line in here. See that little line? Okay. It shows you the earnings event. It's like, look, okay, there's a reason the implied volatility is this high. There's a cut point and it's warning you. By the way, it's like one of the features that I wish they had in Thinkorswim. They just don't. Because people always miss earnings. They're like, holy crap, earnings hit me like a ton of bricks. I didn't even know it was coming. It's in the option chain in Tasty. Cool stuff. So again, we're going places over here. So as we start to learn about this expected move, the place to start, okay, the place to start is, look, let's say that this is $100 stock. You knew I was going to bring stock into this. It's a $100 stock to begin with. And it has 20% okay, IV. That is marquee example I've used for years. What a 20% implied volatility means, this is for 1 year. That's for 1 year. And you go, well, that means the stock can move up, okay, about 20%. 20% is up $20 or down 20%, which is down about $20. And it's supposed to stay in that range 68.3% of the time. Now, immediately when I say that, okay, there's so many questions over here. People are like, oh, come on, man. That's where the stock's going to move for a year. Okay. I want to know tomorrow, monkey. I was just showing you tomorrow. How do you do that? Well, once you know how far a stock can move within a given period of time, couldn't you just divide out? Okay. When I say divide out, you can say, well, if it's going to move that much a year from now, how much could it move, for instance, a month from now? And you go, you could divide by 12. You could divide by this. Actually, it's called the square. Options decay at the square root of time. So you could take the square root of number of days left trading days, and you could say like, all right, I can figure out how far the stock can move even hour to hour. Once you actually know some of the equations in there, you don't need to know any of that. You don't need to know any of that. It's all in the trading application for you. Okay. All I'm here to do is to bring you into scope of what to be looking at and what's proper and how to really interpret that. Interpretation of implied volatility, okay, makes you a better trader now, today, not tomorrow, not a week from now. It makes you a better trader right now, okay? Because Tesla, I know its implied volatility was nowhere near 92%. So Tesla, okay, is saying, I'm getting angry, I'm getting heated, okay? You can feel it. But people, they don't look at a chart on things like implied volatility. There's not an easy way to look at that. You kind of have to just look at it on a day-to-day basis. Go, holy crap, it's at a 92 vol. He makes a good point. Okay, you look at Nvidia, go, oh, it's like 61. But JP Morgan is what we're here for. Why? Because it's got earnings. And JP Morgan is so ironic, but JP Morgan is at a 67 vol. Oh, it's heated, but it's still not as heated as like Tesla is. Okay, and then you look 8 days out, and the vol is like 32%. So here's the thing: when we start talking about earnings, okay, and earnings related trades, because in the money, like in the end, you have to convert this to money, right? In the end, you got to take like 67 vol, and it's such cool knowledge, but how are we going to convert this to a profitable game plan? How are we going to convert this to a profitable strategy? That is, I'm going to take you from A to B to C to D. Okay, I'm going to take you along this. It's understanding how instrumental these numbers are. There's also a comment that I want to make before I go any further. There are many individuals, when they look at the 67%, okay, implied vol, they go, ooh, that's high for JP Morgan. Maybe, okay? What you're going to learn right now, though, is going to be the really cool part. So we're going to move forward. Everybody okay? I'm okay to go. I'm okay to go. Just going to move past this. The 68% of the time, of course, you're going to ask, what happens to me the other 32% of the time? Don't worry, you're going to find out, okay? Expected move. We're going to evaluate, okay, several short duration weekly expected moves and make sure you know, okay, what it is that we're looking for. So expected move can really key in around earnings. But before I go into that, you want to see how really efficient expected move is, okay? Let's go ahead. Let's get crazy, okay? Let's get crazy with this, because people, you ain't seen nothing yet. When I start bringing this up, okay, let's go over to SPX, the mother of all products. And I call SPX the mother of all products because it really is. SPX drives order flow, okay? Every one of these little hash marks on here, and I do this every evening video that I record, every single time that I'm on Theo Trade, okay, when I'm live, which is every morning for usually an hour. Today I'm winging another extra 2 hours in here, but every single time I'm live, in no uncertain terms, I'll bring up expected move. because this crap is incredibly, incredibly efficient. In the side of the SPX, before I get to earnings, okay, I want you to understand these three little lines drawn on the screen, okay? 1, 2, 3. This right here, okay, is where the week started. This is the upper edge of expected move, okay? This is the lower edge of expected move. How do you know what this is? Well, I give it to you every single week, but this one's plus or minus 65 bucks. It means we're going to move $65 higher or $65 lower. Now, you will see it from time to time, okay? Like this previous week, breach. You're like, oh, it broke through the expected move. But the expected move can also provide you incredible support and resistance. So all of a sudden now, I'm taking the knowledge of options. And you go, well, how did you even get the $65? We'll get there in a minute. Don't worry, I'm going to go back. But I'm taking the power of options, and I am absolutely making it applicable, okay, to directional bias. Why? I don't know. Maybe you should just look at this morning. Okay, this is this morning. This line, this is now an intraday, 1 day, 1 minute. That line right there, that is, okay, the upper EM. This is taken down to a 1 day, 1 minute though. We closed on it yesterday, opened and faded, period, okay? This line is the happy place. And you go, how does it work like that? Like, why does anybody even care? Like, how do you know that $65 is right? Because in the beginning of the week, it said $65 is the expected move. And you go, yeah, but whatever, man. So expected move, it's not based on some line drawn on a chart. This is because I'm leading into it, people. It's not based on some line drawn on a chart or a figment of a trader's imagination. You knew I was going to bring up a 618 sooner or later. That's like the fifth time, but okay. Expected move is based on billions of dollars at risk, okay, within a live market. See, what people don't get about the expected move, and you're going to get, and what I want you guys to understand, when I say it's plus or minus $65, that number of 65 bucks, it's not just some ridiculous equation. It is an equation. It's an expected move equation, okay? I don't mind saying this. The expected move equation on Thinkorswim, okay, it was a paper that I read that I shouldn't have had my hands on, okay, all the way back in like the late 90s. And then I had another paper I shouldn't have had my hands on from another trading firm that a buddy of mine worked at, okay? And then I realized like everybody's using I mean, I always knew about expected move, but some of the papers I had the mathematics behind it, okay? What do they say? The best form of flattery is just stealing something. So I took the equation, we massaged that thing for like, I don't know, 7 or 8 years, and we finally put it into Thinkorswim. Obviously, Tasty has it. All the major trading applications now have an expected move equation. What an expected move equation though really is, it's an averaging formula, okay? And what it really is, it's skin in the game. When you say, okay, that, you know, oh, plus or minus $65, $65 is the line on the game. Has anybody here, like, I hate to use gambling analogies, hate it, okay? But at the same time, has anybody here ever wondered, like, you go to Vegas and they go, spread on that game's 3.5. How do they know it's 3.5? Because of traders. I mean, traders come in there, they're like, I'll take Kansas City, I'll take Kansas City. And they're like, oh, I'll take San Francisco. Okay, you know how much money was traded on those games that we know about? Okay, billions and billions of dollars, okay, are traded on some NFL game. And an NFL game is a joke in comparison to what you're seeing here in the SPX. There's so much money on the line in the SPX that we're actually drawn to the line. You go, well, holy crap. That kind of explains a little bit more. The amount of option volume today is a self-fulfilling prophecy. It's not even like, you know, prophetic. It's basically, if you bet, okay, a $500 billion, which easily, and some expirations, okay, actually, we just came off an expiration. There was a $3 trillion OpEx was the June expiration. It was over $3 trillion. You start to pay attention to this crap. $65 is an averaging model. And the averaging model basically says, in every trade made, okay, and the implied volatility, we're going to move 65 bucks. It's that easy, okay? It's that easy. And it's really important. Somebody said Tasty Trade is not as good as Thinkorswim, okay? Well, thank you. But there's a kicker to that. Tasty Trade is better for equities. Thinkorswim is better for index products. You'll also know I was an index trader. I'm an SPX OEX guy. Okay. Whereas some of the people over at Tasty, including Tom Preston, was more of an equity monkey. We fought for years. I don't do anything with Tasty though. I mean, I trade there, but I don't have anything like, bearing on their equations and so forth. But it's billions of dollars at risk. Like, I just want you guys to understand that it's not some like ridiculous, it's a skin in the game trade. It's skin in the game. And there's so much skin in the game at this line that it literally causes, like, I always talk about the expected move, like right here. That's the happy place. It's the happy place for trade because it's a line where risk just goes and kind of dies out. You will see weeks and weeks and months of data. We trade, just look back at this, at the upper edge and the lower edge of expected move. Look how many weeks in a row, right? Look at this. We're skimming the edge of the expected move. We're skimming the edge of the expected move. We're skimming the edge of the expected move. We're skimming the edge of the, I mean, it just goes on and on and on and on. Okay. It's not just some like, ridiculous line drawn on a screen, 618. It is a skin in the game, real time, okay, analytical tool. Okay. Onward. I had to get through that. Can expected move knowledge help you provide a tradable edge? This is where things get interesting because you ain't seen nothing yet. Application of expected move. Breathe, people, breathe. Everybody okay? Everybody okay? Because look, we've only, 40, 50 minutes into this. Okay. And I wanted to go back to, again, the origin of this stuff. Because, when it comes down to earnings, people are like, okay, man, I don't need to know the background. I just want to trade. But you actually kind of have to understand not just how it's, look, how this indicator works. You want to know the knowledge of why it actually works. So our knowledge of expected move became very apparent originally in SPX, index products, many years back. In fact, if you are so curious, I have data, and I share this with everybody, but I have data going back specifically. This is SPX, okay? I started tracking expected move officially in SPX in 2017. What started in 2017? Why 2017? Why? Okay, it's when they started listing multiple expiration cycles per week. That's what really got me going because I knew at that point, like weekly options have been around for a long time. Weekly options now have been around for like a decade and a half. Obviously, some people know this, but not everybody does. Weekly options, the whole idea of weekly options actually came from Tom Sosnoff. And I was there at Chicago Board Options Exchange. We pitched the idea to Chicago Board Options Exchange. I was a kid of 24 years old. I got to run the computer in the slideshow. And originally, they weren't called weeklies. They were called quickies. He's like, who wants a quickie? And I'm like, oh, that fell really, really flat. Okay. Everybody that was on the board of the Chicago Board Options Exchange at the time was, how do we say this nicely? Okay. They had a couple more rings around the tree than Tom or myself. Tom's like 20 years older than me. Okay. He's even older than that. Okay. He old. Anyway, he's about 20 years older than me. Okay. But he old. Anyway, they had a few rings around the tree. They didn't think the idea of the quickie was funny. So I've always followed weeklies. I've always known about weeklies. But when they added the Monday, the Wednesday, and the Friday, now they have daily expirations. All I knew immediately was going to change trade. So I started tracking it all the way back down to 2017, and it is freaking amazing amount of data in here. Okay. But then we started tracking it even beyond that. Okay. Earnings announcements. So the whole thing was this. Once weeklies gripped hold in the SPX, then I started looking at weekly expirations specific to equity products. Okay. It's all about volume. Earnings announcements bring the heat. They bring volume. Okay. They bring volume. Some people have never heard the quickie story before. Holy crap. It was 100 times worse than I even made out to be. Okay. Like it was like literally me. I'm 24 years old, like reading the room and I'm like, oh, this name quickie has fallen flat, like kind of kicking him under the desk over there. Tom wasn't exactly get it. Who wants a quickie? I mean, he must have said that like 8 or 10 times during the presentation. And I was just like sliding deeper into the seat, deeper in the seat. I'm like, can this table cover me at this point? Okay. It was bad. And yeah, he had the beret on at the exact same time. Okay. Got a long hair guy. Okay. All they knew is like this thing, Thinkorswim, was exploding in size. We had just become like a public company. They wouldn't even let us in the door before that, other than like we were seat holders at one point. But anyway, hmm. uh, so anyway, they had called us back like a week later. They go, "We love the idea. We're changing the name," and they bought it. They actually bought the idea. The worst idea that Tom ever had was selling the idea of weeklies. If we had just received a 1/10% on every trade, okay, 100th of a percent, it would only be about like, $500 billion. Anyway, our knowledge of this, though, it changed everything. Like the weeklies really did change everything because stocks adhere deeply to expected moves. Why does stock adhere so deeply to expected move? And it comes down to one idea, okay, and one idea only. Stocks adhere deeply to the expected move, okay, because of volume on them. If you look at JP Morgan today, let's move away from the index products. Let's move back to JP Morgan, which is only moving $1 today. Okay. But it has earnings tomorrow morning. So this is everybody that's going to trade earnings today. Place your bets, place your bets. If I open up today's option statistics, okay, this is some pretty good volume that it's doing. Moreover, if you open it up, forget about open interest. Let's look at what's called volume. Just how much volume is trading in here. All right. Under volume, you're going to see, okay, there's some size definitely a trading, but all that size that's trading, and there's like 3,000 contracts here and 1,000 contracts here. You do realize like, and there's 6,000 contracts over here, 6,000 contracts of a $210 stock. Okay. Put on your big boy pants. That's a lot of skin in the game, right? That's the key. The more the volume in here sets the implied volatility. Traders set the implied volatility, supply and demand. But I say volume sets the implied volatility because I don't give a crap if something trades like 10 contracts a day. You want to see something trades 10 contracts a day? You want to see amateur hour? Go look at, okay, CMG. I always pick on Chipotle. Chipotle is actually trading a little bit today, but I always pick on Chipotle because it doesn't do a lot of size. Okay, it's trading more size now that they, chopped it up. It's a burrito. They chopped it up. Now that one's going to fall flat. That fell flatter than Quickie. Anyway, they chopped this thing down to a $57 stock, but it still has like 5 cent, increments. But it just doesn't have volume. There's no real big punch behind it. Okay, whereas JP Morgan right now, look at the why does this thing keep just putting in random symbols? Okay, Thinkorswim's angering me. Okay, we're no longer friends. Me and Thinkorswim. Anyway, you can see tens of thousands of contracts are trading in here. The more size, the more efficient that expected move is going to be. I'm going to say that again. The more size, the more efficient, okay, the expected move is going to be. So, for some of you, the 68%, look, when we logged on here and we started talking about this less than an hour ago, that thing was 66%. Now it's 68%. What's going on? Okay. What's going on? Anybody know? It's going to be an easy answer, right? I know exactly what you're going to tell me. Okay. I don't have to think too much about this one. So what's going on in this underline? Come on. This is real-time stuff going on over here. Okay. So there is what? Well, jump back over here to the platform. Apparently volatility is going higher. Okay. Apparently volatility is going higher. And we're not scanning for any of this. Don't even worry about any of that. So volatility is going higher. I'm actually really going to tell you what's going on. Volatility is going higher because time is moving forward. And as volatility goes higher, time moves forward. You guys understand time decay? Options, the closer you come to expiration, okay, close to come to expiration, options are decaying. The decay rate must be offset by volatility. Why? Because what vol crush really is, And this is where crap gets crazy. Like people's head, somebody's head just popped open like a cantaloupe. That was awesome. Okay, let me close this up and actually explain it on here. Okay, here's time. Okay, and time decays as we move forward. Okay, and here's vol. Now this is before earnings, and vol is going to go up. Why? Because we have an option marketplace where the expected move equals plus or minus $6.29. We must keep the $6.29 stagnant. So what you're going to see is the closer you come to expiration today, the higher the volatility is going to go because it's offsetting more and more of the decay. But it's still going to keep that expected move right around $6.29. And that can vary a little bit. But I want to get into this because you know what people really think? They think that they're selling a high implied volatility, which is a bunch of beep and another thing, beep, beep, beep. It's all crap. High implied volatility isn't really high implied volatility. Okay. There's going to be a big boy vol crush. Volatility is going to go collapse because the marketplace is anticipating a $6 move. An expected move is everything. And volatility, okay, is just an artifact of that. The implied volatility is going up, but the implied volatility has to keep going up, and it keeps going up, and it keeps going up because it has to offset decay. Why? Because we must keep the expected move around 629. If I looked at JP Morgan, okay, yesterday, that implied volatility is going to be lower. Let's go look at JP Morgan yesterday. You go, how the hell did you do that? I went into what? Okay, I went into Think Back. What's Think Back? Think Back is actually a backtesting tool. It's a really crappy backtesting tool. It doesn't even work very well in Thinkorswim anymore. Sorry, I don't mean to rip on Thinkorswim, but let's just put it this way, okay? Since Chuck has taken over, okay, things are a little, how do I say this eloquently? Chucked up, okay? A little bit chucked up. Now, I'm not ripping on him. It's just, you know, there's a lot to worry about on here, but Think Back hasn't worked as well as it used to, okay? If anybody from there is listening, okay, fix that crap. Look at the expected move yesterday. It's $6.39. It's almost the same as it was today, but the implied volatility was 56%. So now the vol is 68%, and yet, hold on, the expected move has dropped to 629. You go, okay, that's when the head cracks open like a cantaloupe. All it's doing is, this is, remember, vol is going to go up, okay, because time is actually dragging the option down. We must skirt the line through the middle. So don't ever listen to, if somebody says, oh, it's high implied volatility, we got to sell some high implied volatility. It's not about implied volatility. That's why this session is not called volatility crush. Okay, it's event crush. Okay, it's about event. It's about event risk, and this has event risk in it. It's earnings. Okay, and if I back up even another day, you know what's really cool? If I back up another day, look, the vol is 45. I just want you guys to see this. The vol is 45. But it's still a $6.40 expected move. Just keeping the expected move stagnant. It's bouncing around a little bit, right? Goes up and goes down, it goes up and down just a little bit. But generally speaking, okay, that IV has to go higher to keep the expected move. Okay, yeah, are we good? Are we good? Yes, okay. There's been a lot of caffeine today. It's good stuff. S&Ps haven't moved yet today. Here we go. Advanced decline line's getting better. It's an interesting day. So how are we going to make money from this? Okay. This stuff is so cool because let's just get down and dirty with this. You got to position yourself around expected moves. How do you position yourself? Okay. Most effectively around earnings expected moves without absorbing large amounts of risk. Okay. Now, this is going to be crush trades. So what crush trades basically are, all right, for those of you that understand some of the logic behind this, okay, when we start, getting into detail about like, okay, let's really start to break down, all right, where are we in these crush events and so forth. Crush events are all about expected move, okay, hits. What you will find, okay, is following an earnings announcement, okay, you will have an incredibly high probability of hitting the edge of expected move, okay? Let's start with JP Morgan, okay? Here's JPM, okay? And JPM is plus or minus, let's just call it $6. $6 equals the expected move. So here is a stock that is trading roughly at 207. You guys with me? It's going to go up $6. Okay, where's it supposed to go to? Where's it supposed to go to? Well, basically at 213. Don't think hard about this. If we go down $6, okay, you go into around 201. Now, timeout. The mathematical terminology, for those of you that are more mathematically inclined, you're supposed to stay in expected move range 68% of the time. But the research that we've done, not about 68% of the time. And the research that we've done under the crush events, okay, you hit the upper or lower edge, and that's it. Basically, what happens is there's so much skin in the game that you're forced to the upper or lower edge of the expected move, and there's unlikely to be any in between. Now, from time to time, you'll pierce through the upper, or pierce through the lower, or we could say somewhere in between, okay? But many, many times you have an incredible probability, okay, of hitting the upper or lower edge. So this 207, and you're all okay. So we're supposed to go to 213, or it's supposed to go to 201. Let's take a trade for that. That's it. Let's take a trade. And what do you want to use? Okay. So we have a class that we actually built. Somebody actually said, there's a class for the archives. We have a class that we built in this, but it has been years since we've gone this in depth. Okay. And we have so much more data now. Okay. It's exemplary on top of this or this. Okay. What you want to do, when it comes down to earnings, what can you do? When people think about earnings and earnings related trade, well, you could be, okay, bullish. Okay. You could be bearish. All right. You could be neutral, what we term long. Okay. Or you could be neutral short. This is it. There are 4 things you can do around earnings. What that basically means is if you look at the expected move and the expected move says, okay, we're at 207, supposed to go to 213, or we're supposed to go to 201. Okay. You can do, well, one of 4 things. Bullish, well, you think we're going up. But where are we supposed to go to? Well, if we go up, we're probably going to go to 213. Well, you could be bearish. You go to 201. Well, how are you going to know if we go to 201? Well, you could be bearish. Neutral long and neutral short. Neutral long basically means you think we're going to move outside the expected move. Neutral short means you're going to be inside the expected move. There are 4 earnings trades, and that is it. Somebody goes, what about double calendar spreads? Yeah, double calendar spreads, okay, are actually a neutral short. What about double diagonal straddle strangle swaps? Neutral short. What about in-out spreads? It's either bullish or bearish. What about iron condors? Iron condors are what? Okay, neutral short. What about long iron condors? That's neutral long. Every strategy that you have will key in to one of those 4 things. So what we're going to do is we're going to play the game a little bit differently. Okay, we're going to come in and we're going to play pin the tail on the donkey. Okay, are you donkey? So here's 207. By the way, I want general consensus here. Okay, I'm actually going to trade based on what you tell me to trade. Okay, you tell me. Let's go back to JP Morgan for a second. All right, because screw it. Let's put some money at this. Let's have some fun with it. JP Morgan's literally trading 207. Couldn't be better. The expected move is $6.35. Okay, I want a consensus. Are we going higher or lower on JP Morgan's earnings? Okay, you don't have to put skin in the game. I will. I came in here and I had an idea and I wrote it down. I actually didn't. Okay, I really didn't. I have my my little notepad. Okay, I have my little notepad over here. Damn it. Okay, but it didn't have that. It just said JP Morgan, Wells Fargo, Citi, because those are the 3 with earnings coming out. Okay, what is the consensus? Are you bullish or are you bearish? Okay, I want to know your consensus. All right. Wow, higher. Holy crap! Almost everybody in here, okay, is bullish. Almost everybody. Okay, you know one thing: the volatility is going to crush. Okay. By the way, Ken's great. He says options value is going to be a lot lower. That's true. Okay. Almost everybody in here is bullish. Holy crap. I'm looking at both, chat rooms higher. Okay. So what we're going to go out then and do, okay, is we're going to lay a trade specifically for that. Now, okay, I'm going to take you into higher math right here. Okay. When I say higher math, Ready for this one? Okay, we're going to take the current price, which is 207. Okay, 207.07. And we are going to add the expected move, which is going to be $6.35 equals 213.42. Okay, 213.42. Now, there is no 213.42 strike. Okay, and if I round it, probably 212.50 is the closest. I'm just being realistic. Okay, that's probably the closest is 212.50. You're like, but it could be 215. Just relax, okay? Just relax. Okay, clearly I'm not relaxed. It's close, but I think the 212.50. What we're going to do, okay, I'm not going to try to play both sides of this. I'm going to take a directionally biased position. I'm going to show you exactly why. So the market here in JPM, okay, equals 207. The expected move equals plus or minus, okay, $6 and we'll say 30 cents. So I'm going to key into something that is higher because the vast majority of people should higher. So you're like, okay, so it's about 213 and change, but there is no 213 strike. So it's 212.50. Okay. You have to round. It is what it is. What I'm going to do, okay, is I'm going to lay on top of here what we term a crush trade. What's a crush trade? So you know one aspect. You know we're supposed to move $6, and you know that volatility is going to crush. We're going to go after a butterfly. Now, a lot of people, they just freak out when I mention butterfly. It's okay to freak out when I mention butterfly. Okay, you've never traded a butterfly. We're going to go buy. Okay, butterfly. Buy butterfly. Butterfly is going to cost 23 cents. Okay, now it's 23 cents, but hold on. We're going to come over here and we're going to analyze the trade first. We're going to analyze it. Okay, close that up. I'm going to kind of zoom in over here. All I want you to see, where we're presently trading, okay, where we're presently trading is right here at 207. Okay, if we go up. Now I'm using your suggestion. This is not me, it's you. Okay, your suggestion. If we go up and we go anywhere near like this 213, we're gonna have a wildly profitable trade tomorrow morning. Okay, what do we have to pay for it? You know what? Honestly, I don't think I can fill it for 22 cents. I think I can fill it for 24 cents though. Okay, and in doing so, what can you make off of it? Easily, I can make $1 off this tomorrow morning. It'll actually, if it opens anywhere near 212, 213, the trade's immediately going to go to 80 cents. Then within 10 minutes, it'll jump to $1.10. Okay. I mean, unequivocally, how the hell would you know that? Okay. Because I've traded butterflies for decades. But I know that this thing's going to trade between 24 and 25 cents. So I'll go out and actually work one there. I'll come in here and create a duplicate order. Watch this. I'm going to work one at 25. It's not going to fill there. Okay. Oh, we did fill. He scores. So we filled that one. Okay. I'll come in, cancel, replace this order, whack it at 25. We're filled. Okay. So I just filled just a 2-lot. Captain 2-lot rides again. So I'm 2 contracts into this. How much money did I really risk? $50 plus transaction costs. You know, the best part of leaving the brokerage world, I don't have to say that crap anymore. Anyway, okay. Normally I would do this in like the last 90 minutes of trading day, but I don't care. I'm live right now. Okay. It makes you more exciting TV. So more exciting TV. I just risked $50. Okay. So I have the upside vol crush trade on. Okay. And if we hit, we hit. And if we don't, you go, what's going to happen if we don't hit? Why aren't you trading both sides of it? Because I can take you through all the mathematics of what we term expected return. Okay. And in doing so, it's such an interesting trade. Even though everybody's like, oh, you placed a bullish trade. Okay. Here we are at 207. You placed a bullish trade looking for 213, but we went down. Who cares? What am I going to lose? 25 cents? On a 1-lot, that's $25. But that $25 can easily be worth $100. So what you're doing is you're basically picking up these lottery tickets. How often do you have to hit to make this profitable? That's the key, people. How often do you have to hit to make this profitable? You have to understand something. Butterflies, okay, and these vol crush trades are inherently lower probability trades. They're inherently lower probability trades, but we found a higher probability edge, okay, taking it and wrapping it around, for instance, a $6 expected move. I don't care that it's JP Morgan. You care that it's JP Morgan. I don't care. Okay. Jamie Dimon doesn't care about you. You shouldn't care about him. That's great. It's a $6 move from 207 to roughly 213. Lay a trade on there. If I'm wrong, I'm wrong. I'm wrong. Okay. You only have to be right in this case. Okay. Just to break even between after transaction costs between 20 and 25% of the time. But you're actually going to find that your probability of making money in here much higher. It's a much higher because if you looked back over a huge number of occurrences of earnings trades, which we have, okay, your probability of hitting the upper or lower edge of the expected move, okay, is actually over 43%. So the trade in here, by the way, I don't know if we're going higher or lower, but there's a 43% chance we're going to end up here or here, okay, on a trade. Like you're doing a trade that has like a 1 in 5 chance or a 1 in 4 chance, okay? But you're trading for a 43% probability, like that's freaking amazing. Okay. You want to know what edge in this business is? It's that crap. And a lot of people don't understand the 43% versus this, okay? You will. You just got to go through and you got to trade it. Look, this is why you want to use these earnings crush trades. Highest rate of return surrounding earnings announcements. Extremely low upfront costs, overall risk. Okay. And again, I can pop this. Somebody said, pop it in there. Okay. In Theo trade, I'll go ahead and even fire this trade into the chat room. Okay. So this is Theo trade. Let me just come over here, create a duplicate order, copy this, paste it down below. Right. So I just put the earnings butterfly in there. Now, before I go any further, I could actually deviate and go right to Wells Fargo. And Wells Fargo has a $2.65 expected move. You go, what do you think of Wells Fargo? Okay. Well, I'm not even going to ask you what you think. I think this thing sucks. It has nothing to do with Wells Fargo. I just feel like feeling a little bearish in the morning. So I'm going to use some higher math on this one. Okay. It's $60.32. Boop, 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 boop. The expected move is 270. Somewhere around like that 58 level, pretty good. Okay. It is. So somewhere around the 58 level. The key to this one's going to be a little harder because I got to go buy deep and wide, 1 month, 2 strike. Okay. Double diagonal straddle strangle swap. I'm just kidding. Butterfly. And this one's for about 40 cents. You're going, 40 cents. But this one, you're like, but it can only make $2. Yeah, but because the butterfly actually costs a little bit more, it's implying a slightly higher probability. And this one, I'm probably just going to have to work it, right? I'm working on that one right now. I'll bump this one to 41 and it'll fill. He shoots, he scores. So I'm going to just put in 1 on that. And you go, why'd you only do 1? Because it had one trade that risked 25 cents times 2, which is almost $50. The other trade risked 41 cents, which is almost $50. So I'm trying to keep each one of the trades, okay, the same. In terms of capital exposure, I want to keep the trades almost the same. What you would want to do, okay, is during an earnings period, scatter this crap all over the place. You put on, 3 trades a night during earnings, and you're going to hit. You only have to hit. If you hit 1 in 3, okay, you're gold, Jerry. You're gold. Something's going to hit. It's going to be fun. Okay, I like it. And this is exactly the way that you look at earnings. You don't have to sit here, okay, and I'm just looking at my account today. You don't have to sit here and try to preface like what you think is going to happen. So what? I just took a bearish trade in Wells. Okay, took a bearish trade in Wells. Predicated on what? Right? I just laid that crush trade right over there. I mean, that's what this is. So people, they always think of like earnings are some magnificent beast. Look, earnings are a very simple idea. Implied volatility goes up because time's going forward. Implied volatility is going up. Basically, it's all about expected move. If it says it's going to move $2.30, it's pretty high probability it's going to move $2.30. You go, but I don't know which way. Make me more accurate. You don't have to be that accurate. You're right 1 in 3 times. If you're right 1 out of 3 times, you're a huge winner in this business. Okay. Who's the big winner? Mikey is. Anyway, highest rate of return surrounding earnings announcements, extremely low upfront cost. You never are going to buy or sell the stock. Okay. You have to be able to exit this though tomorrow. You got to be able to exit. We're not going to sit here though and tell you like, oh, this is the price to exit. Again, I built a whole class on this. Okay, a whole class on this. And what I'm doing in this mini class is, because I built a class back in 2019 on this, we have so many people here at TheoTrade that have never been through it. Okay, you have access to the archive. You got access to the archive. Again, you're providing a consistent earnings trade without having to continually monitor positions. And it's such a nominal amount of risk. Don't feel like you have to get in. You got to have big skin in the game. You don't have to big skin in the game. I just basically traded $90 of risk, okay, with some huge freaking upside. Like, you know what? In an earnings announcement, what if you placed 3 or 4 trades a night during earnings season? Okay, 3 or 4 trades a night, you might be able to make $500-600. That's with doing one lots, $500 or $600, like, you know, out of the earnings season. That makes it worthwhile. And again, you know, I'm being a little like, you know, oh, like that's one lots. You put on 10 lots, $5-6 grand. Okay, look, earnings crush trades will give you the power to trade massive stocks around earnings with mere pennies, okay, at risk. And that's the key in here. You do not have what I would constitute as critical amounts of risk involved, right? And okay, with all of this, as I said, you can go through and everybody's like worried about the scans and so forth. Look, it take 2 seconds, come over here to a scanner, hit scan, okay? It'll give you everything that has earnings. You don't have to use this, okay? You don't have to use this like, oh, I could do all of these. Look, there's, by the way, this is the next like 4 trading days. You can come in here and even knock it down. You know, stuff that's actually interesting. JP Morgan, Goldman Sachs is not till Monday, as I recall. Okay. Yeah, Goldman Sachs is not till Monday, but there's going to be ample trading opportunities for earnings. All I wanted to do is just scrape the surface of this. Okay. I could do Citi. I did JP Morgan. I did some Wells Fargo. Okay. BlackRock. Oh, there's a company everybody loves to hate on, right? That's not till Monday. Oh, I guess I'll have to wait till Monday. Okay. Somebody's got a case of the Mondays. Anyway, with all of this, right? If you want trading alerts, okay, Inner Circle. So we have a new Inner Circle, okay, kicking off, and we are changing the Inner Circle. For those of you that do not know, okay, what Inner Circle is, okay, Inner Circle starts July 18th. It is 24 highly detailed, curated sessions with me. What I'm doing in Inner Circle, and I'm going to get to that in just a moment, because some people have actually been through Inner Circle, but it kicks off July 18th, and it's 24 weeks. And the stuff that we do in Inner Circle, this is a class that we have in TheoTrade that I covered today. In Inner Circle, the entire idea is to go above and beyond anything we've done in TheoTrade, anything that's archived, okay? I try to push the envelope. Today, I just wanted to refresh and push, okay, back to earnings, because earnings season is coming up and it's wild right now in markets. It doesn't matter what you think. Like, oh, this is such a bullish market. Okay, it's right now such a bullish market until a day like today. Inner Circle, it's 24 weeks. We're now going to build a portfolio and do 3 live trades per month are now going to accompany Inner Circle. The 3 live trades a month, we can do earnings crush trades, inverted catapults. People, I don't even know what the hell that is. It's good, okay, because you're going to learn what it is. Christmas tree trades, okay, funky ratio and infinity spreads. I'm going to go where nobody's gone before in this stuff. So I have trading ideas to the likes of which many, even Theo traders, have never known before. And I know a lot of people that have been through Inner Circle that it's been there, done that. No, you have not. Okay. As I said, I'm going where no Theo trader has gone before. Inner Circle is now changing. I'm going to tell you exactly what I'm doing with Inner Circle. I'm going to reduce some of the theory. Some people get really lost in Delta Gamma Theta Vega. I like talking about that stuff, but I'm going to reduce the number of weeks we spend, okay, on the theory side of it. And I'm going to increase more strategy. So strap in, because we're going to talk about, even there's going to be in-out spreads. Pick out in-out spreads is old school, man. That's easy. Yeah, we're going to tweak that. Okay, in-out spreads and tweaks. earnings trades, similar to vol crush trades, funky ratio spreads. There's all kinds of stuff. We're going to beat the living crap out of skew, Christmas trees, VIX volatility spreads, okay, and catapults. Catapults beyond your wildest imagination. Catapults in inverted volatility skews, where you're actually doing a catapult within one underline. Okay, it's going to blow people's minds what we're going to do with the next inner circle. Now, the inner circle and the Theo Trade 2024 live event. I am the instructor for Inner Circle. I will be assisted by the way, the Inner Circle is a very small group environment, okay? But we have literally almost a one-to-one touch rate. You ask questions in there. We are assisted by Todd Sweet, Brandon Chapman, and Blake Young. There are 4 of us here at Theo Trade that are intimately involved, okay, in the instruction of Inner Circle. I actually lead, though, 100% of all the discussions. I lead all 24 weeks. Each session, it's 24-week mastermind, is 90 minutes. We are going to put 3 trades a month into that. Some of the trades are actually going to be done while we're live at the session, okay? In addition to Inner Circle, okay? And again, Inner Circle, I guess the easiest way to say it's 24 weeks, okay? And it will challenge the most experienced of traders in there. Do I try to overwhelm you? Yes, I do. And every session is archived, okay? And every session, you get infinite amounts of email, okay, back and forth in there. You're also, all of your emails are queued first if you're in Inner Circle, meaning that the second your email comes in, you know, Todd, Brandon, myself, Blake are on it immediately. In addition to this, we have unlimited trading horizons. Now, some people have like, oh, what the hell is that? Okay, that's actually the name of our newest event. So we have an event that we're going live. Okay, so that event is coming up, and I'm going to describe that here in just a moment. Just looking over here. So the event, okay, Unlimited Trading Horizons, that's our Scottsdale Live. It's a live event. You can also stream it live, okay, and the event is completely archived. It's 3,000 right now for both. Now, let me go into Theo Trade live event. Pretty strongly suggest get out from behind your computer. Meet the entire Theo Trade team. There's going to be education. We do feed you. Okay. There's prizes. We actually have prizes because I think that's actually pretty cool. Somebody wins like a Falcon computer and so forth. It's actually going to be in Scottsdale. It's a nice time in Scottsdale in September. It's only like 105 during the day, but it's a dry heat, like a convection oven. Anyway, it's a really good time to golf too. It's still relatively inexpensive. People can actually afford to golf, okay, in September. By the way, somebody was also asking me, like, well, what else can I do, you know, in Arizona? If you rent a car, go up to Sedona. It's much cooler. Go up to Flagstaff. It's day trip. Come up here to Payson. In September, I'll be down though in Scottsdale already. I have kids that are going back to school. I'm going to go to the island during part of August, and I'm going to come back here in September. Okay. But we want to see people live in September. We absolutely want to see people live in September. It's September 12th through the 14th. And I'll give you all the details on it. Okay. You're going to be able to break bread with Theo Trade and guests. By the way, we've now confirmed, this is the first time I'm mentioning it because we only confirmed him yesterday, Tom Sosnoff. Okay, so Tom from Tasty is going to be speaking at that. He'll probably do at least two major speaking times. For those of you, if you went to last year's event in Florida, okay, Tom, like I actually got to interview him for like an hour and a half. That was completely off the hook. We learned so much about the inside of like Tasty, the original building of Thinkorswim. That was probably like one of the highlights of it because I even brought him under the to the edge. I'm like, tell me something we don't all know. And he told us about what small exchange is going to be. It's super cool. Paul is actually coming from the CME group. So CME group is one of the big sponsors of Theo Trade. Then, of course, we have Tony Rago, Blake Young, Jeff Bierman, Corey Rosenblum. I can get that out. Corey Rosenblum, Gianni. Okay. By the way, fun story. None of us have actually met Gianni in person. He's a real person. Okay. He's a real boy. Brandon, and of course, myself. So here's Blake Young. And okay, scary as he is, he's getting a couple of rings around the tree too. These are his topics. We haven't even announced this yet. The triple threat trading system, okay? The money flow squeeze strategy. So Blake Young, these are his two topics, of course, at the live event. And remember, the live event, you can show up live in Scottsdale or you can stream it for the comfort of your own home. The way though, okay, the live event is going to work. As I said, you can show up live or you can stream it. It will be archived. For those of you that are live, you can actually go home and again watch it. Only, okay, this 24-week inner circle, okay, plus the live event is, well, pretty spectacular deal. But these are Blake Young's live event topics. This is Tony Rago, the life-changing power of one simple setup. His second topic is Day Done, okay, the road to daily profits. Then we come to Jeff Bierman. Jeff Bierman, Wall Street's secret weapon can be yours. He's actually going to be talking in depth, okay, on the Genesis cog. You guys have seen a million emails about Genesis cog. You've probably spent some time looking at it. He's also going to be talking about the parachute trading system. I also threw a third topic in here. I'm smiling on this one because I'm actually going to go Don Kaufman versus Jeff Bierman. We're going to do this in a happy hour session. Okay. It's the odd trading couple. It's options mega geek versus Professor Chart Tweak. And they say opposites attract. All right, Corey, although I'm still cracking up about that one because they put me on the spot. They're like, give me a topic for the happy hour. And I go, all right, okay, Professor Chart Tweak. Anyway, significant profits in sideways markets is Corey Rosenblum. If you guys don't know Corey, okay, I'd say on an intraday basis, okay, pretty much the hottest thing we got going right now. The one pattern for spotting a trend, Gianni, okay, none of us have actually met Gianni yet. Become a momentum master. Okay. Oh boy. Hidden wealth in secret cycles. I guess there's some 618 that's going to be discussed in that one. Then we come to Brandon Chapman, surviving, okay, the death of the dollar. That is such a cool, by the way, in terms of like currency, Brandon's the guy to listen to. Big money magnets. You guys are going to love actually some of his sessions. I'm into it. He is huge into macro. So macro, geopolitical, Brandon's absolutely spectacular at it. And of course, myself, okay, one of the talks I'm going to have is building future trading concepts. Like, how do you come up with something like the catapult? How do you build something like an earnings trade? Okay. The second one I'm going to talk about is all skewed up. Okay, a trader's guide to Christmas tree spreads. So I'm going to do another discussion, of course, on Christmas tree spreads. Then I've got the session with Jeff Bierman as well. And yes, we are also bringing in Tom Sosnoff on that one, Paul from CME. Live events. The live event, okay, will absolutely sell out. We're only supposed to fit 150 people into the live room. If we have to, okay, we could fit very close to about 200 into the room. The big, though, X factor this year, okay, by the way, we're very late in promoting our live event. I say very late. That is an understatement. We're very, very late, okay, in promoting the live event. It's in September. We're already in mid-July. Why? Because we know it's a total sellout. And the big factor this year, Theo Trade, okay, the list that we shoot out to is 3 times larger, okay, than in previous years. So this is an early bird opportunity, which I'm going to explain here momentarily. Inner Circle plus Scottsdale Live, okay? It's a package deal, people, because Scottsdale, a ticket to the live event costs $2,000. A ticket to Inner Circle in 24 weeks costs $2,000. It's $3,000 right now for both of them. And we're doing that obviously to incentivize. By the way, this is so cool. This is actually the Scottsdale venue. And this is all of us. We actually took this photo. I think this one was actually taken from a ladder, but in future years, I know we had a guy with a drone there. I think that's Jeff Bierman. Okay, it's Jeff. I don't see Brandon in here, but Brandon might have to be like squatting down below because he's a Sasquatch, like 6'6", okay, 6'4", 6'6". I don't know. It's all Sasquatch to me. I'm 5'8". Anyway, it's $3,000, includes Inner Circle and Scottsdale live event. Okay, look, now is the time to learn these strategies. There's geopolitical events. Obviously, it's an election year. The Fed is going to get ready to reduce rates. There's a prime time discussion, okay, as of like literally like a few hours ago. There's a recession coming, okay? Everybody's discussing that. Look, Inner Circle and Theo Trade, okay, 2024 live event, all right, it's $3,000. And we are going to do something we have also never done before. And I'm going to throw this in here. Okay. We're going to put a 30-day money back guarantee. The reason is there are some people that have never experienced Inner Circle before. Inner Circle will kick off next week. Okay. And even if you're thinking about it, check it out. Okay. We can't do a 90-day money back guarantee. The reason we can't do 90-day money back guarantee, because that includes a live event. That's just wrong. You're going to come, you're going to eat our food. Okay. The live event is incredibly expensive for us to host. We're about $250,000 in the hole for the live event before anybody's even signed up. The biggest, I would say, impact to our business in terms of inflation is this live event. The event is anywhere from 3 to 4 times more expensive than it was, okay, 4 years ago. It's shockingly bad. But we're still doing the live event because it's cool. It's come out, touch, taste, feel, okay? Don't touch or taste me. I'm a germaphobe, okay? Germaphobe. Just you keep a 2-foot distance, we're going to be just fine, okay? And definitely no touching, okay? No touching in the men's room. No touching. There's a great story I have about that. I'll have to tell that at the live event, okay? I had somebody asked me a question one time. I'll give you the short story. One time somebody asked me a question, okay? Except I was, okay? It's in the men's room. It's the non-touching zone, okay? There's touch-free zone. Anyway, we're going to do a 30-day money-back guarantee on that Inner Circle. But again, I'll take you guys over to the page. Here it is right here, okay? And if you scroll now into this page, it is theotrade.com/I as in igloo, C as in cat, theotrade.com/IC. We'll post that, of course, into the rooms. So you scroll down to the bottom of this. And of course, oh yeah, it's actually one of the last live events. So there's Bierman, there's Blake, okay? Everybody looks like they're having fun. We don't have a live picture of Gianni. Gianni, it's an unknown to us, okay? Brandon, did I call him a Sasquatch? Okay, he's bigger than that. Anyway, scroll down. Again, we're going to do a 30-day money-back guarantee on it because we want to pack the live event. And you could do a single payment of $3,000 or 3 payments of $1,000. It's completely up to you. Anyway, bottom of the page actually has the enrollment form on there. If there are questions, by all means, please, okay, feel free, ask. If you need to call us right now, it's 623-244-5657, and you can get a hold of us. I just want to make sure that everybody is thrilled with going through something like the Inner Circle, of course, the live event, and that's why we're kind of packaging this together. Unlimited Trading Horizons is the theme, of course, of this year's Scottsdale live event. As I said to you, you can stream the live event from the comfort of your home, but you still have to buy a ticket for that. It is, again, a really special event. We try to keep it very, very tight knit. And I much prefer when people do come live, and it's worth the trip out to Scottsdale. As I said, I would think Grand Canyon is more than a day trip. Okay, Sedona is a day trip. Flagstaff is a day trip. There's so much stuff to do, especially in like the time of September. It's still hot down in the valley. Okay, there's a lot of cool stuff, and obviously you're visiting. For those of you that do play golf, it's pretty much the golf mecca of the world, especially at that time of the year. So with that, I want to thank everybody for tuning in today. If there are questions, we'll answer them in the chat room right now. But for those of you that are going to stay live on TheoTrade, we're going to bring on Gianni in just a few minutes. Stay tuned. Again, it's theotrade.com/IC. Thanks everybody for tuning in today to this mini class. Hope you guys enjoyed it, learning a little bit about crush events. And yeah, those trades, they're on. We're going to see how things go tomorrow morning. Have a good one. Bye-bye.